Hey everybody, this is David Skarica. So this is another video for Jason Burrock, Wall Street for Main Street. So I'd like to thank again Jason for giving me the opportunity. This video is going to be a little more like the last time I did a bit of a PowerPoint. I really don't do that in my stock chart of the day. Normally, I like to kind of go with the flow. I come up with some ideas which I think are unique, or like we talk about maybe a stock that's in the news after earnings or some news or a big move in it, etc. And then it will kind of lead me to other things and other interesting research points to look at. That's kind of what I really like to do here. And that's what we are going to do here today. So again, I'd like to thank Jason, and for those who are stumbling on this and aren't subscribers to Jason's channel, I recommend it as well. I did get a few dozen subscribers, I noticed, to the YouTube channel from this, and hopefully that just continues to pick up. So what we're going to look at today is right now we're in this seasonal strong point for stocks. I don't know, a lot of you know about seasonality trading and the whatnot, but usually there's a thing like sell in May and go away, and you buy in October. So October 27th, this is a great site called Equity Clock, run by a friend of mine named Don Vialu. He actually has a seasonal trading ETF that trades up in Canada as well, which did very well. But you can see on average, since 1973, so 50 years, it's been positive 78% of the time. So basically 39 of the 50 years, 8% on average. Max gain has been 28%. Min has been minus 18%. Usually in bear markets, you can see October 73 to 74. That's usually when they hit, like in 2007, 2008, you'll see the same kind of thing. But one thing you're going to see even in these down years is that once you get through October, crashes happen in September, October. There are numerous reasons for this. A lot of them are actually just psychology. Some of it is portfolio managers sometimes panic, or people panic when they're not performing well, and the whatnot. But once you get through usually October, even if there is a decline in the fourth quarter, and I'm going to show you some of these fourth quarter declines coming up, is that usually the decline in that fourth quarter is quite muted. So with myself personally, I was very heavily short. I've taken some of these shorts off, and I probably will take more of these shorts off before I look to re-enter. I still think right now, with gold closing over 2,000 on Friday, it looks to me, and with that resistance looming at 2050 to 2100, in gold stocks are better play here. Like in late 2000, okay, the stock market still went down for almost another 2 years until late 2002, but being long the gold equities into 2003 was a much better trade than being short equities, short regular equities. So that's kind of where I see we are now. Obviously, there's room for shorts. You always want to hedge, but that's kind of what I want to show you here. And we can see this again. If we go back to, I don't know, let's go back 20 years to 2003. You can see only 1, 2, 3, 4 times in those 20 years. So roughly in line with that 78%, that is 20%, or 80% up. Has the market been down in this October to November timeframe? And usually, like I said, usually there's rallies in the fourth quarter. And even in 2020, when the COVID shutdowns hit and the market got obliterated in March and April, it only finished down 5% because there was a huge run in the fourth quarter that year. So you can see, again, the bear market, but most of the decline was over by October. Actually, most of that decline in November, October. Some of it actually happened. The stock started to swoon late in the year. So we can see from this, the fact of the matter is, this is a seasonal strong point for stocks. Stocks usually go up from the fall into the following spring. Bear market years, if we are in a bear market, they can be weaker. But again, in that fourth quarter, which we're going to show you, usually the declines are quite muted. And I think you're better off just stepping away and then coming back in, say, December or January and setting up your shorts. And we're going to show you examples of this. And one thing I do want to show you about the market, though, as a whole, is the market is being driven by a few stocks. Now they call them the Magnificent Seven. You're kind of after that that movie in the 1960s, the Western movie, and the Microsofts, Apples, Amazons, Nvidias, etc. The usual suspects, I guess you could say. And these are accounting for most. They're mega companies. Most of them have, Tesla would be in there too. Most of them have north of $1 trillion market caps. And so they make up a large part of the market. And you can see that the market is up 10% year to date, the S&P roughly, but the equal weighted S&P. So if you took every stock in the S&P and just weighted it equally, so a stock that's worth 1% of the S&P is worth as much as a stock like the Apple or whatever, the whatnot, that's worth 7 or 8%. And you can see the equally weighted S&P, the S&P is actually down 2 to 3%. So it really has not been another great year for the markets. And the question is, will portfolio managers just kind of, go back into the Magnificent Seven in the fourth quarter, and that props up the market to the end of the year? Or will they catch down with the rest of the market? And there's going to be other factors. That's the problem with the rest of the market. The stocks are done poorly. Portfolio managers will sell them because they don't want them on their books year end. You have tax law selling in them, et cetera, et cetera. So what we're going to look at here in today's stock chart of the day, this is where I go into some other things. Well, let's say the market now, we are in the seasonally strong period, but let's say even in a bear market, what does the market look like in the fourth quarter? So we're going to start here with 2000, and you can see here in 2000, the market did go lower to the end of the year, but you closed about 1320, and the S&P began the end of October at like 1380. So it was only down 5%. That's really not a huge move. And actually the S&P was flat roughly going into the middle of December. So I always think, like I said, I think you can still be short here and have some short positions, but I really would not be as short. And I would look to basically add, there's going to be some kind of bounce in November, December. I would look at to add on that bounce going into the new year. And if we go out even further, we're going to go out to the end of 2001. Of course, you'll see a big decline after 9/11. And what you'll see is, note that the market actually rallied all the way into, January. So again, putting on these shorts in December, January was a better idea, and then swoon to new lows for that bear market here into March, April, or sorry, of 2001. So again, I think that even if you are bearish, on the markets, I think the decline would come more in the first, second, third quarter next year rather than to the end of the year. So let's go look at 2007, another bear market year. And 2007 was a little unique because the market actually topped in October, not in the summer, where in 2000, the market topped in the summer after a rally. But again, we're going to go look at this, the fourth quarter of 2007. And again, you can see the S&P was, the top was here about 1550, closed at 1460. Again, not a huge decline, a 5% decline. And again, if you would have waited for this rally into December, you could have shorted a 1520, only a few percent off the highs. So, and then in 2008, I'm not going to go into the financial crisis, but let's go into the first quarter of 2008. And what you'll see here is, again, the market after this kind of December top just absolutely swooned into March. The S&P started the year at 1450 and went to 1275. That's about almost almost a 200-point drop, or almost like 12-13%. So I just think, again, even if we are in a bear market, even if the market does not have the seasonal rally all the way into May, and you are bearish, it's more likely that this decline is going to happen kind of into, the first quarter of the year. So let's look at a year where actually most of the bear market or correction happened in October, or in the fourth quarter, sorry. And this was 2018. In 2018, if you remember, the market actually bottomed right around Christmas, okay? And you can see here, here you would have missed a shorting opportunity. But even then, the S&P was if you had sold in October here, the S&P was 2,600. It was 2,500 by the end of October, or 2,650. Is that a big really move? You missed 6%, because realistically you weren't going to short here or the whatnot. And if you had waited to mid-December to short, you would have had basically the same profit and only had to be short for a couple of weeks, not a few months. So that's kind of what I'm really looking at here. I don't think it's worth it. And by the way, this is about as big a decline as you're going to get in the fourth quarter. So, but even then, in the end, from middle of October to the end of the year, this ended up only being a 5-6% decline. So, and again, if you go look at gold in the same time frame, it's kind of like the similar setup where the Fed was stopping the rate hike cycle, and the market had been declining as they raised rates. And gold, you can see, look what it did here. It went from just over 1,200 to 1,281. That's a nice move of 7%. And gold in the years that followed, you see gold was up to 1,400 less than a year later. So a rally of nearly like 16, 17%. So I think that's kind of where we are now. We're like, okay, you can be short the market here, but the market is off 10% from the summer highs. The S&P is off nearly 700 points, or about 14% from its all-time high, reached in late 2021. So do you really want to be short here in the fourth quarter, or is it time to really start being in the precious metals, et cetera, et cetera? And I just think gold and gold stocks are better risk reward here. So I know this is a stock chart today. I just wanted to show you this, that we're in the seasonally strong period for the market. So I think that's another reason to kind of take shorts off. And then you combine that with the fact that usually there's not a huge decline in these last 2 months of the year. There's never been a stock market crash in November, December. There's been, declines, like I just showed you, December 2018. There've been corrections, but there's never been an all out and out crash. Usually when you're out of October, especially when the market is up year to date, because then again, portfolio managers want the strong stocks when the market's up year to date, because they want to, even if they underperform the market, they want to say, oh, look at, I own, Apple, I own, NVIDIA, I own, et cetera, these kind of stocks, right? So I think now is the kind of the time. I'm going to wait for the Fed meeting, and there's a couple earnings, this week. But I definitely think by the end of this week, I'll have a significantly lesser amount of shorts. I've done really well. Like I'll show you right now, one of my shorts that I've owned through my family members is, we got to get the chart here, is the SKF. This is a financial short. You can see this has done really well. I really loaded up in this in the summer at 17, 18. It's up well over, in the double digits as a short. So again, I'll probably be taking some money off this. And there's a couple gold stocks I really like. That's fortunately just is for the paying members of Stock Chart of the Day. But anyhow, again, I just wanted to show you that I think the next few months, I don't think if you are someone who's heavily short right now, you really want to be heavily short. History has shown us, you saw in all three of those scenarios I pointed out, 2000, 2007, 2018, all 3 years where the market was weak in the fourth quarter, that actually going into December was your better entry point. You basically could have got in the same place that you shorted in October and get the same gain. And I don't know if any of you have shorted, but shorting is very stressful. I did it a lot in 2021. I started getting the blue bags under my eyes. I wasn't sleeping. It's much more stressful than going long because it's much more short-term orientated, especially if you're playing some options and the whatnot. So I would just kind of wait here, chill out. We got Thanksgiving coming up in a few months. I'm a big football fan. Watch some football. Look for a better re-entry point. Right now, I would look for good, solid precious metal stocks to own over being short the market here, because it does look like to me that precious metals are on the verge of breaking out. Maybe we'll talk about that in next week's special edition. So again, I'd like to thank Jason. This is my page, Stock Chart of the Day. It's YouTube at Scott Day, youtube.com Scott Day. Sign up if you want, and then if you like what you see, hopefully we'll get you'll become a Patreon member, et cetera, et cetera. I'm actually starting a higher end service I'll probably launch next year, where I will do a daily chart for 30 members who are willing to do this. It's going to be an expensive service, but you'll get access to all 30 charts. So once a month, I'll say that a member on this service will be able to ask me for what they want me to talk about. And then as a member to that service, you will get to see all 30 charts. I'll probably limit it that because I want to do it one chart a day. I may go as high as maybe 45 members on that service, because I don't mind doing one chart every day and then maybe 2 charts every second day. But that's something to watch out for too. Again, it's not going to be cheap. So, because that's a lot of work. So, and like I said, I'm going to limit that to probably 40 to 50 people. And I hope you enjoyed this. And I hope I've kind of shown you, the seasonality factor is not really on the side of being heavily short the next few months here. And if you tie that into, it looks like short-term interest rates are topping. I would say it's a time to just kind of, like I said, look for some cheap stocks. et cetera, et cetera. And actually, again, for Patreon members, I have a numerous stocks that are down between 95 and 99% off their all-time highs, which I think are going to be good plays here in the fourth quarter. So everybody take care, and I hope you enjoyed this.